This voice is taken from an article with the title, How to Interpret Surprise Deviations from Economic Calendar Expectations, which has been published on TraderTalks.net. The economic calendar is an important tool for Forex traders, as it allows them to stay informed of important economic data releases. It provides a timeline of when market-moving news is due to be released, such as central bank meetings, GDP figures, employment data, and inflation readings. By tracking these releases, traders can gain an idea of how the market will react and adjust their trading strategies accordingly. Rise deviations from the economic calendar expectations can have a significant impact on the market. A sudden increase or decrease in the value of a currency can be caused by unexpected economic data, such as a surprise rate cut, unexpected inflation figures, or a surprise GDP reading. It is therefore important for traders to understand how to interpret these surprise deviations, in order to make informed decisions and take advantage of any potential trading opportunities. Firstly, it is important to consider the overall context of the surprise deviation. Unexpected data can move the market in either direction, depending on whether it is perceived as positive or negative. If the deviation was due to an unexpected rate cut, for example, this would likely be seen as a positive development, as it could indicate that the central bank is attempting to stimulate the economy. As a result, the currency may appreciate in value. However, if the deviation was due to an unexpected rise in inflation, this could be seen as a negative development, as it could indicate that the economy is overheating and the central bank may need to raise rates. In this case, the currency may depreciate in value. It is also important to consider how the surprise deviation compares to the consensus expectations. If the deviation was very large, for example, if the actual inflation reading was significantly higher or lower than the consensus forecast, this could indicate that the market was unprepared for such an event, and may cause a larger than normal reaction. On the other hand, if the deviation was relatively small, for example, if the actual inflation reading was only slightly higher or lower than the consensus forecast, this could indicate that the market was somewhat prepared for such an event, and may cause a more muted reaction. Finally, it is important to consider how other traders are reacting to the surprise deviation. If traders are taking advantage of the market volatility by buying or selling the currency, this could indicate that there is potential for a trend to develop. If traders are cautiously waiting on the sidelines, however, this could indicate that the market is uncertain and may not move in a single direction. In conclusion, interpreting surprise deviations from economic calendar expectations can be a difficult task, as it requires traders to analyze the overall context of the deviation, compare it to the consensus expectations, and consider how other traders are reacting. Having a clear understanding of how to interpret these surprise deviations will help traders make informed decisions and take advantage of any potential trading opportunities.